So Jake, you feel there's a certain class here that's going to be booming. We're talking 10% plus increases in value. Let's talk about it.
Yeah, so big bold prediction number two, and it's not crazy bold, and it is just coincidence that it's the type of multifamily that Mike and I serve a lot of. But I think in 2024, values for 3 units in the 600 to 750K range, and also 4 units in the 800 like million range. So that's 3 to 4 units in the 200 to 250K per unit range are going to balloon at least 10% in value as of what their prices are today or Q3 of 2023. So a few reasons, right? I mean, the big one, and this is all kind of contingent upon what Mike just talked about. If rates come down, numbers start to make a lot more sense, right? Additionally, we've talked about it already, or you guys have talked about it on the podcast, and there's a lot of good chatter around the 5% down conventional house hack loan, right? This financing is going to be opening up the doors for a lot of those buildings that previously we couldn't bridge that FHA gap for. And that's right in that range. Those 3 units above 600K, where you had to either put 10% down with a portfolio loan, or you had to force FHA to work, which you typically couldn't because of the self-sufficiency test. I don't think that's gotten legs yet, right? Like, we haven't seen a lot of demand for it. The rates are still too high for a lot of clients coming and saying, you know, we get a lot of feedback from buyers and house hackers in that range saying, like, I just want this to break even post move out with about 10% down, right? And right now it's just not happening, right? Just because the rates are too high. But if rates come down to the mid fives, all of a sudden we're seeing, like an example, $700,000 3 unit that's collecting, call it $1,600 a month per unit. So $4,800 gross for a $700,000 3 unit. Pretty realistic, right? At a 5.5% rate with fair, everything else, taxes, insurance, expenses, vacancy, all that good stuff. That's a break-even property at 10% down post move out. Again, not a home run, but when we're talking to clients and we're poking around the MLS, that if it's in a good neighborhood, it is a win. And it's just not happening right now, but it would happen if we dip into the fives. And I think we will. So this just hasn't caught up. There's this pent up demand. House hackers have money. They haven't done anything in the winter. I think in March, April, May, it's going to get crazy. And those neighborhoods with that inventory are going to see a big boom. Neighborhoods that have those, far northwest side, south side, few to kind of point out that had the highest density, and I did a quick search: Albany Park, West Irving Park, West Rogers Park, Portage Park. These are the north and northwest sides. If you go south, East Woodlawn, Bronzeville, Marshall Square, kind of little village areas, these areas that are kind of fringy. But I just don't think it's caught up yet. And I think if you can scoop any of those buildings in that price point right now, call it a 600 to 700K legit 3 unit that have slightly under market rents. Maybe the rents are in the 1,400 range, but they can easily be in up to 16. Those aren't going to last. Buy them now.
Well, think about the opportunity with the new loan programs, the amount of people that now can qualify, or just say have the down payment, right? There's people that save for 3-4 years to get that 20-25% down payment. Now they only have to save for a year, So the time between I want to buy and the time I write that first offer, or I start actually making moves happen, has shrunk, and that will only create more buyers, which will ultimately drive our pricing. So I can see how that can definitely play into what you're saying.
Well, and then in Chicago, real quick, because our housing pricing, especially on the north side, it's high, taxes are high. Like, how many deals actually pass the self-sufficiency test? It's definitely a minority. It's a minimal amount, right? If you put 10 deals out there, maybe one will pass self-sufficiency. Like, FHA is a great program, but the 3 to 4 unit game on the north side, it's almost, I don't want to say it's unicorn, but it's tough. Like, most of them will not qualify. And now with 5% down, like, you don't have to worry about the self-sufficiency. Like, that's just a huge point that we gloss over here.
And I don't think the 2 units, maybe the 2 units in that like 500K range, I still think there'll be demand for them. I just don't think they're going to see that big of a jump, because you could still already do FHA for those, right?
Yeah.
Even the 2+1s with the bonus units, you can still buy $600,000 decent, nice 2-unit with a basement or an attic and just use FHA. You don't need to have this new program. And so it was kind of like, I just see it bridging that gap with those, there's still going to be those like $1.3 to $1.4 million 4 units that are great. And if you can put 5% down and you're okay with negative cash flow, fine, great, go get them. I just don't think they're going to see a big boom because even with rates in the 5s, those aren't amazing on paper post move out, right? You put 5% down on $1.5 million place, you're
loan's
probably
too high.
you're in the whole $1,800 a month, right? It still doesn't,
Well, 3 units is the one that the self-sufficiency has failed on more times than not.
Exactly.
So I think
100%.
that will benefit from that the most.
Just to be clear to our listeners too, there's no self-sufficiency test on the 2 unit. It's on 3 units and 4 units. The 3 units get hammered because you only have the 3 incomes coming in compared to the 4.
Right. And to be clear, the 5% down program has no self-sufficiency test and the PMI is much lower. So it's just no one's really going to need to use FHA, in my opinion, unless their debt to income ratio is, not what it needs to be in the lender's eyes, or their credit score, doesn't allow. Otherwise, the 5% is going to by far make a huge difference this year.